Hi, this is Michael Carlin, President of Henry & Horn Wealth Management. We're bringing to you today a stock market and COVID-19 update. Before I get started, I hope that you and your family are doing well in these most difficult and troubling times. It's important that we take a step back and look to see exactly what's going on with the stock market. It's going to translate into your portfolio. It's going to translate in what you should do. We're going to try to lay out an overview about what we see to help you decide a little bit more clearly about some of the things that you should be looking at during these difficult times. So with that, let's take a look at the stock market. And I realize that some of this data on the screen is tough to read, but let me take you through it. You'll see that from the market peak in February to where we are today, the market's down, as of right now, somewhere between 27.5% to 28%. This is a significant sell-off, the likes of which that we haven't seen really since the market's at 87, the stock market of 2000, and most recently the one of 2008, where we had steep and massive sell-offs in the market that was saying a lot about where we were economically. And this sell-off is also saying a lot about where we economically are at this time as well. You know, it's entirely likely that given where we are economically right this minute, that we're in a recession. And even though the economic data doesn't reflect that yet, it wouldn't surprise us to see that as the economic data is released, that's what we indeed see happening. Because we're also seeing bonds, which are normally the safe places to invest, also down as well. Municipal bonds down almost 5%, and regular different types of bond indices down 1.25%. So there's really been a difficult market where there's almost no safe place to hide. What this shows is that we've had major sell-offs like this recently a couple different times, 2015, 2016, in the fourth quarter 2018, and here's where we are now. We're now down 28% from the peak, and you can just see how quick and sharp that sell-off is. This is the one that we just faced in the third quarter as our China trade talks melted down, and here's where we were in the oil collapse. That happened in 2015. If you think about it, we have two events going on right now. We have an oil collapse with prices under 30, hovering in that $20 a barrel plus range. And we have this coronavirus, which is giving a huge amount of uncertainty, especially as we're now facing government shutdown. And this is going to impact a bunch of businesses very, very differently. There are a whole bunch of service-based businesses that, frankly, they're going to lose economic activity that they're not going to be able to recover. You know, if you were going to go to an amusement park once this month and you miss it, are you really going to end up going twice when this whole COVID-19 virus is over? There's some lost economic activity that businesses are going to be struggling with, and you're seeing that reflected in stock prices across the board. So we want to keep our eyes to see exactly how long this coronavirus situation might last, and what we do have in terms of data is how long it lasts. If you look at the new cases in China, you can see that there's been a dramatic amount of cases that have not been reported, again, where we're seeing a dramatic improvement there, and also the same kind of thing in South Korea. What's good to note here in the United States is that we have taken and we are taking very aggressive measures to prevent the spread of the virus by limiting social contact. So with that kind of action, we're hoping to find this peak in this trough where we are expecting to see coronavirus cases increasing in number, especially as the testing kits are really now going out en masse. And as those numbers go up, we're really trying to see what's the peak and when will the growth in those new cases start to subside. And if you listen to those, government experts that are coming out and giving us what we think is pretty good data, it's likely that we're in this kind of, additional 4 to 6 week time period before we start to see the peak of cases here in the United States, and then eventually a sell-off. It's important to know that, because know that the market is already expecting that, and anything that we get that's more favorable will be good for the market and your investments. So on the next slide, what you'll see is that, the big question is, oh my gosh, Michael, do stocks look expensive? Is this a time to buy? Number one, if you're the type of person where you have a long-term time horizon, you're always looking for good opportunities to invest in stocks. And if you're looking, this chart goes back to 2010, and you'll see that when you're looking for stocks that are down 20% or more from the 52-week high, this has been the best buying opportunity that we've seen in a decade. Does that necessarily mean it's cheap? The answer is maybe. We're going to talk about that a little bit more. So on the next slide, you'll see that the stock market leads recessions. Here's what that means. The stock market looks forward. The market is reflective of things that it thinks is going to happen in the future. With that information, let's take a look to see exactly how long some of these kind of previous bear markets lasted, because by the way, we're in one right now. How long can we expect it to last? If you look on bottom, this bear market has lasted so far 1 month. So, and the average of bear markets, even going back to the Great Depression, is 20 months long. So you're thinking, oh my gosh, if we're 1 month in are there 20 more months to go, or 19 more months to go on average? The good news is that the vast majority of the sell-off will likely happen in these early days. The market's fully reflecting it seemingly right now as we're really starting to figure out exactly what's going to stay open, what's going to be closed over the next couple of weeks and months. And there is precedent where you've had these bear markets that are really short, in 3 months in duration. So is this going to be like the market of 87? And if you remember the market of 87, the Dow dropped about 22% in one day. The whole downturn lasted 3 months' time. In 1990, where we had a whole bunch of different issues with the RTC and a bunch of financial issues, financial bank issues. Yeah, this was a relatively short-lived market correction. It seems likely that we're going to fall under the camp of this is something that is known. We see it. We can see other countries where there's net improvement in the COVID-19 virus. And with that kind of information, it looks to us like this is something that should hopefully be short-lived. And the big question is what do I do? We appreciate and we understand exactly how trying these times are. The number of phone calls that we are getting and emails that we're getting with concerned clients and concerned people is very reflective of the times. So I wanted to give everyone a historical perspective on what to do so you can do this right. If you look, and this is, by the way, the most recent data, March 15th to January 1st, 1995. I mean, you can take a look at any 15 or 20-year window in the past and say, well, what if I just left my money invested? And by the way, from 1995 to the year 2020, you had a bunch of things go wrong. You've had this market meltdown, you had the 2008 meltdown, you had the 2000 meltdown, you've had the dot-com bubble bursting in this whole window here. Wow, what a difficult time to invest, a whole bunch of different opportunities to panic. Well, look, if you just left your money alone, your rate of return would have been 7.3% invested in large U.S. blue chip stocks. Cool, great. But what if you got worried and you ended up missing some of the best days of the market? If you remember, one of the best days of the market this past year was one of the best days of the market we've ever seen, and that was Friday of last week, where the market was up 2,000 points in one day. If you miss some of the best days in the market, and they tend to be buried within some of the worst days of the market, over a long period of time, you can get punished. Look what happens if you take out the 30 best days in this 15-year period of time. Your return goes from a positive 7 to 0.5%. If you miss the best 40 days, forget it. You got a negative rate of return. Even missing the best 5 days over that 15-year period of time, your rate of return would have gone from 7.3 to 5.5%. So what we encourage everyone to do is to think long and hard about your goals, your objectives. What's the purpose for your money? Are you living off of it? Are you really setting it aside for long-term growth? And do you have a plan? If you need someone to talk to, you can certainly reach out to us at any time. You can find us on social media at Manage the Funds. It's all one word. You can send us an email or certainly contact your accountant or your advisor. Have them get us in contact with you, and we're happy to take you through your portfolio, where you are now, and maybe some portfolio evolutions that you might make to make your portfolio more optimized given where we are right now. That's your COVID-19 stock market update. If you have any questions, please let us know. Take care and have a great day.